Future trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome once again to Pasture to Pin, a bi-weekly series from the EverAg Insights team. Each episode, we bring you news and updates on the cattle markets with the intention of helping cattle producers manage their risk. I am your host, Michael Todd Rowen, coming to you from my home office in the Texas Panhandle. Before we get started, let me timestamp this episode. Today is Tuesday, November 28th, 2023 at 3:05 in the afternoon. Per usual, I am joined by my co-host and teammate, Mr. Trey Freeman. Our guest on today's episode will be EverAg's commercial protein team lead, Mr. Jim Sullivan. Gentlemen, welcome to the show.
Good to be here again, MT.
Thanks, MT. Always fun to be here.
It's a pleasure to have you both. Leading off the show again today will be winter wheat conditions and weather. Over 91% of the winter wheat planted has emerged in the 18 states that are reporting winter wheat. Of those states, 85% is in fair condition or better, which is great news and usually means we are getting precipitation. On the weather front, parts of western Oklahoma up into Kansas received over 8 inches of snow this past weekend. The 7-day forecast also looks very promising for further precipitation. Dry states like Louisiana, Mississippi, and Alabama can expect rains coming out of the Gulf, while the Pacific Northwest also looks to get precipitation coming off of the Pacific Ocean. Scattered rains and potential snow also appear to be in the forecast for the Great Plains on up into the upper Midwest. Switching to the cash market, while futures continue their wild ride, cash prices have, for the most part, stayed resilient. On Friday, 11/26, while feeder futures were running for the hills, the CME feeder cattle 7-day average jumped $4.40 to $230.38. Similarly, while live cattle futures on that same Friday were also moving lower, the 5-area weighted weekly average only lost $1, moving from $177.79 to $176.79. The cutout has actually posted gains week over week from 11.20 to 11.27. The choice side of the cutout gained $1.50, moving from $295.75 to $297.25. Select, however, has moved lower in that same time period, falling $3.15 from $270.95 to $267.80. Trey, my friend, what in the world is going on in the futures market?
You bet. Well, today feeders finished $7 to $8 a hundredweight higher. Live cattle $3 to $4 higher, with a face-ripping rally after extremely oversold conditions following the sharply lower closes on Friday and again on Monday. So we'll just get right into it. What caused the recent sell-off? Was yesterday's action a blow-off bottom, or is today's price action merely a crackback rally just to be met with another round of short? Looking at the charts, February live cattle and January feeder cattle had pennants forming on the charts, with prices closing right on the lower trend line of those pennants Wednesday before Thanksgiving. Now, pennants occur as prices coil up in a trading range, which is often indicative of a breakout soon to come to one side or the other. Coinciding with this, the 200-day moving average on the front month rolling contract in feeders was only a few ticks below the close on Wednesday. So with that said, I suspect that this extended downside move Friday and through Monday was purely technical. Chart analysts recognized these areas of support after the close Wednesday, and these prices were right on or above these areas of support, and traders took advantage of the opportunity to push prices lower on the expectation of light volume, which we typically see around holiday trading time, and ultimately led to a horde of sell stops being hit and in turn plunged prices. Now, that's my take on it. There's a million different takes. I never would have thought we would have seen a sell-off to this magnitude. Sometimes you just got to say, I don't know. I had tough finding any reason for that magnitude of a sell-off to occur. But looking at the charts, a lot does add up between that pennant and the 200-day moving average, and traders maybe wanting to take advantage of that on the expectation of lower trading volume. Now, moving forward, short traders that entered the market the prior 2 trading days, they'll be on margin call, and they may be blowing out of their positions now being on margin call. So I wouldn't be surprised to see a recovery into the end of the week.
Trey, thank you for that. I find it interesting that you bring up the 200-day moving average because the front contracts, Jan feeders and D's live cattle, have their 20-day moving average below the 200-day moving average, as well as the 50-day tracking below the 100-day moving average. I feel like most seasoned brokers and traders would throw things at me for even tracking the 100-day or 200-day. Would you agree?
There's a million different indicators to break down chart action. Everybody has their own unique perspective of how to trade them and which indicator to complement another with, and so on and so forth. So this doesn't go to say that chart indicators are worthless when it comes to gauging entrance and exit points, since they're not always on the same page. It just means that there isn't a silver bullet indicator out there that tells all. So that'll bring me to the Keltner channel, which I've talked about again, but I want to show you a chart. Now, looking at the Keltner in February live cattle, you can see from April 1st to May, we started trading in the upper half of this channel. This middle moving average line, that's a moving average. The upper band, it's going to swell and contract with volatility, but you can see a trend of prices trading above that moving average line and often hugging that upper band, and sometimes trading for consecutive days above that upper band before retreating, and then traders not allowing that 50-day for price action to break that middle moving average before they start buying again aggressively. So you can see this trend in an advancing channel where we're not breaking support of that middle moving average line and we're hugging that upper band. I would use this with a pattern evolving here to avoid establishing protection whenever we're trading in the middle of that channel, because it's advancing and we tend to bounce off that middle trend line and move up to that upper band. And so I would be more aggressive to establish protection on that when we're trading around that upper band or above it. Now you can see since September, that channel has since become a declining channel, and the complete opposite has happened. Now we are having trouble breaking through that middle moving average line. Back in late October, we busted through the lower band sharply, traded consecutive days below that before making a retreat and having a modest rally up to that middle moving average line again, and yet to break it. And so again, this is a good indicator that I would use to help me gauge entrance and exit points as far as establishing downside protection. And so you can see recently, as of yesterday, we were well below that lower band. And so again, I would try to avoid establishing protection there. But with today's action, we have moved back into above that lower band and maybe approaching that middle moving average line where, again, I would become aggressive to establish protection. So again, there's a million different technicals out there. You got to find which one works for you and recognize the pattern and trade accordingly.
Very good. Thank you very much, Trey. Now let me reintroduce our guest, EverAg's commercial protein team lead, Mr. Jim Sullivan. Jim, how are things looking in the meat case?
Looking good. Thanks again for having me, MT. And I think I'd start with sort of echoing what Trey voiced earlier. A bit of confusion, scratching your head, trying to figure out what exactly is going on in these markets. I thought we'd start by looking at what's going on in our favorite 50s and 90s beef trim. It's kind of a tale of two roller coasters, right? So on the 50s side, it's been a remarkable roller coaster this year as we began the year near a really low area, about 65 cents per pound. I think we talked about it in the summer when I was on this program, when we were nearing some really high, above $2. That was about in July. From there, the roller coaster went straight down, and it's continued down, so much so that it's now kind of lower than where we started the year, sub 60 cents. There's some seasonal factors in there. It's a kind of a normal thing to see an up and down there in B50s. However, it got higher than it normally did at getting up above $2. On the lean side, the 90 side, that's a roller coaster that has climbed steadily, but the down has not been as steep and as fast as it has been on the fatty trim side. A lot of that has to do with the fact that, especially here in the US, we just don't have as much lean trim as we do as the fat trim. And so therefore, where we actually notched new all-time highs not that long ago, about mid-September. We traded above $3.10 in beef 90s, which was a new all-time high, set up there above $3 for quite a bit before retreating recently. We now sit about $2.75, which if you zoom out a bit, historically, that's still a very high price to pay for lean beef trim. And so when you think about it, you set the sort of roller coaster that we've seen in the cattle futures side, we're still pretty expensive on beef trim. And so your burgers, the fat component is a lot cheaper, which is good. The lean side remains expensive. And part of what I want to look at, in terms of going back to cattle, but also beef, we've seen this year on the slaughter side, we've lagged last year. We're lagging, right? So on the beef production side, we've also been behind. There's been several months this year, as you can see on the chart, look at April or July, or even as recently as September, our commercial beef production has been well below average. And in certain months, it's been like significantly low. Look at the bar for September where we were 2.1 billion pounds when average for September is closer to 2.3 billion. So that trend I think is going to get worse before it gets better. And so as it relates to beef prices, particularly in the lean side, I don't anticipate lean trim from falling much further. And I also believe that 50s are got to be near the floor or the bottom there. I don't see them retreating farther, and I believe they're probably going to start heading back up soon. We sort of mentioned the beef cutout earlier. Beef cutout chart, you take a look at it. It's sort of been on the choice side, been hugging the $3 level, either side of it for a while now. It's sort of been flat. If you're looking for clues as to like what's going on in beef that sort of can show you the way for this massive down move we've seen in the feeder cattle and live cattle, you're not going to find too many clues there on the beef side. The break in beef 50s started well before this break in cattle as far as the cutout goes. Hasn't been doing much lately. The last thing I wanted to focus on, since it is that time of the year, choice ribs, sort of the bright shining star on top of the Christmas tree. It's the time of year where people are getting their holiday purchases done for the choice rib, and that has driven the price of choice rib significantly higher. As you can see, we're not at all-time highs, but we certainly are pretty elevated at above $5 a pound for the choice rib. As you can see also in this other chart, seasonally, pretty much majority of the year we've been running hot in the choice rib. So November's average to date is over $5.25 per pound on the choice rib. I think once this sort of seasonal buying is completed here, probably pretty soon, those prices will retreat as they normally do in December. But again, overall, as we go back to talking about commercial beef production, it's trailing, slaughter is down, and then big picture macro side on the cattle side, that's likely to get worse before it gets better. So apologies that, there isn't sort of something to point to in the meat side that can give you a clue as to why we've been hit so hard on the cattle side. But that is the situation in the beef for now. Again, thanks for having me here. It's always fun.
Absolutely. Thank you for that, Jim. Gentlemen, I know that the Thanksgiving holiday had client and prospect talk kind of light. Just want to pose a question to both of you. What's your hedge here? Because for me, I needed feeder cattle in any of the first 3 months of 2024. Truthfully, I'm looking at buying the board or at least buying calls, maybe to keep this price low and take advantage of this basis between cash and futures.
As cliche as it is, right? What we've seen, especially I was looking at feeders yesterday and on a monthly chart. And feeder cattle, I think so far in November with these big breaks we've seen, we're down like something about $25 per hundredweight. And we're all sitting here scratching our head that why is this so violent and so swift? You look back on a monthly chart and you look at May, I think it might have been the biggest up month of all time. And we're up $30 per hundredweight in 1 month, right? It's massive. Now, fundamentally, there were certainly more reasons for that up move than there are for this down move. But I think what sort of it underscores, right, is that volatility, particularly in cattle and livestock, is always going to be a component. Whether or not there's a good fundamental reason or there's not, it underscores you have to always have some sort of risk management plan and have to have something executed, right? Whether it's a small percentage or a large percentage, because you're always going to probably be confronted by a time where you're scratching your head and you can't find a reason why it happened, but it has happened. So you better be prepared, right?
Yeah, I mean, it just varies by where you're at. If you're 100% protected on this down move and you're looking at some purchases here in the next few months, certainly you got your downside covered. Let's look at the March feeder contract chart. September, that high we posted around 270, and then the low we posted yesterday at around 215. I mean, a 50% retracement would be up to 242.85. I mean, looking out to March, you could get a 242 call for about $3.55 a hundredweight. So that is one way. But then again, if you're 50% protected, maybe look at using something like that Keltner that I was pointing out earlier to layer in protection and kind of gauge where your entrance points would be to layer on more protection. So it depends, but certainly be in contact with your risk manager as far as what options are out there and where you stand, and develop a plan moving forward, just like Jim said.
Thank you to both Jim and to Trey. Excellent insight on this episode. That is a wrap for this episode of Pasture to Pin. Thank you to all of our viewers for watching this episode. If you have not done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. A big thank you to Paige, Lexi, and Hattie, who continue to keep us on the straight and narrow. A very big thank you to the entire EverAg Insights team for making this show a reality. Until next time, stay safe, pray for rain.